other resources for early stage founders. And then Jonathan is coming from Expert Dojo. He's going to be our featured speaker for today's event on rethinking the concept of money. And I'll turn it over to you to give a quick introduction. We're going to do fireside chat format. So I'll be moderating, asking questions, and then also taking audience questions that come through in the chat as well. Jonathan, love to turn it over to you for a quick introduction.
Perfect. Yeah. So, I'm with Expert Dojo. I've been with Expert Dojo since the beginning. Our whole thesis is everything we do here is focused on growth. So everything we do is trying to help a company grow as quickly as possible, help with the KPIs, customer acquisition, of course, helping with the investment side of things as well. So we are an accelerator as well. So we invest $100,000 in each company. Typically we do follow-on rounds up to 1 million as well. So we're pretty flexible in how we can structure things as well. Industry agnostic, and we are an international program. So we're headquartered in Los Angeles, but we have investments all across the world. So we've done investments in every continent, and we're very active around the world. Probably 50% of our portfolio is in the US and 50% is international. So very flexible where we can invest and very hyper-focused on the growth side of things and helping companies scale. But yeah, that's the high level of what we do.
And no, that's perfect. And yeah, so what makes, when you've obviously, you look through dozens or hundreds of applications to figure out which companies to invest in and work with. So what are the things you look for that make one company stand out over the next?
Yeah, I mean, the big things we're always looking for is, do we think we can help the company scale? So I think the go-to-market strategy is always a really important thing, and we're looking for a successful team that can do that. I think a lot of companies get stuck in building versus executing, and execution is always just the most important part. A big thesis of what we're doing, and what we focus on is that growth. And really, I think companies kind of get lost in the building things out, building companies the perfect way, making the product look as great as possible, when really they need to be closing sales, they need to be executing, they need to be going to market as quickly as possible. Because really, when you're going venture funding, everything is just a race against time, and that's what we want to focus on. That's what we want to help with, is helping them do this as quickly as possible, get to your next stage, keep growing the company, whether that's through raising VC money or not. Just keep growing as quickly as you can. So that's what we want to, what we're trying to do is, do we think we can help the company scale? Do they have a good team that's willing to execute that, whether they're seasoned entrepreneurs or people who've just started off but have the right idea too? We'll look at anybody anywhere around the world. Our whole thought process is basically we want to get the whole world involved in this ecosystem, because it's more than Silicon Valley now. There's not just good companies in San Francisco. You can find companies in Africa, you can find companies in India, and really that's why we want to find companies around the world.
And do you think every startup is a fit for some sort of VC funding, or are there certain types of companies that it doesn't make sense to choose that as the money you take in for your business?
It's funny. I mean, every company presents as a VC business, but I mean, a VC business is a very specific industry. Most startups should not be going to VCs, I would say, because when you go to a VC, you have to imagine that every VC, when they're investing, your company has to be able to make $1 billion. It has to be able to IPO. It has to be able to be that huge exit, because they're counting on you to pay back their entire portfolio. So every company has to have that potential. And if a company can make $200-300 million, that's a great company. And what's going to happen is, like, if you don't raise VC money, you'll probably end up owning at least 50% of it by the end of that too. So if that's the way you want to go, you can find angel investors to do a smaller company like that. That's more secure. Usually B2B software type things is where that falls. Not every company needs to go after VCs, because the money is different and they are expecting much higher growth metrics. There's going to be a lot more pressure on you, and you won't have the time that most companies really think they have, because everything in this is just a race against the clock. So I'd say most companies should not be going after VC financing, especially past the seed round is when things get even trickier.
Yeah, no, great answer there. And then, yeah, so I mean, the companies that come to you say, they are a good fit for this financing, and you think you and your team think they're investment worthy. In terms of the services side and the way you can help them, do they typically come in with certain areas they're looking for support, or that's directed by your team on, where you think they need the most growth and experts coming in?
Yeah, I mean, it's a case by case basis, really. Every company needs something different. You may have somebody who's an amazing developer, but usually when you have great tech people, they struggle on the sales and the business development side. Um, so I think most people have 1 to 2 like major skills they're good at, and they're missing something else. So you need somebody who knows the marketing side. You need someone who knows sales, who has customer acquisition growth focus in mind, and then obviously the tech side of things is really important as well. So I'd say the tech side of thing is the hardest thing to teach somebody, because it's really just you have to have somebody who knows that space, because an investor is not going to be able to really just go through with you and build it, help you build it. And there are specific funds who do things like that. And we obviously help on that side of things as well, but everything has to be just, you have to find the right team and compile the right people. A lot of what we do is helping you connect with the right founders, getting things sorted out. We have a lot of hiring things where we'll bring other founders on, help companies acquire new employees as well. So it's really just finding the right fit with everybody's skills, because nobody's going to run everything by themselves. You have to have somebody else with you, because you just don't know enough. Nobody does.
And generally, the founder or the teams you work with, are they, pretty coachable and open to all the new ideas and implementations?
People are people. We're there. We'll never make a company do anything. We're there to give our advice as a venture fund that's worked with over 150 companies, that's invested in over 150 companies and seen thousands. At the end of the day, it's always the company's choice. And in reality, a company should know their market and what they're doing better than we do anyway. So we have generalized advice. We know what we've seen. We can go off of past experience. But if at the end of the day, they think that they know it and they know what this market wants, who are we to say they're wrong? We invested in them because we believe in their expertise in this industry. So they should be experts on it more than we are. And if they come back against us and say, hey, this is why we think we shouldn't change things this way, we're never going to make somebody change anything. But that being said, we always do help with it. We help with everything on there. And if they need anything, we're there to help them and support them. A lot of the time, it's really going down to messaging, going down to the branding, how they're approaching investors, how they're approaching the customers, because that's what I think a lot of companies struggle with, because they're too close to the project. So getting outside view is always important in there as well. But yeah, we'll never make a company change anything, and it's always up to the company.
Great. Yeah, and then, are there any, speaking of the changes a company is making, have there been any cases, I'm sure there are, of like pretty significant pivots or directions the company's gone in after you guys have funded and started working with them?
Yeah, it's kind of funny, since I guess not funny, but a lot of companies, obviously last year was a very rough time for a lot of these companies, and we had several companies that basically were just like, they didn't know what to do. They had to close up shop. They had to do things. But what we really saw were the people who knew how to adapt. And I think COVID was a big test for a lot of those companies, because we had companies that basically, if they didn't adapt, they would have shut down overnight, because they just in-person things had stopped. They had things in restaurants or like beauty salons or whatever it may be. And it just, everything stopped. So what we saw was a lot of people having to adapt. And I think we've seen companies that have gotten even stronger through COVID. Obviously, we had companies that had to close because of it as well. But in my opinion, those companies that closed were the ones that were probably going to close at some point anyway, because the founders just couldn't find a way to adapt to the market. Things are always changing. Where we had an ed tech company, which everything was in person. They built a whole new platform, basically to accommodate COVID, and adapted that. And they kept all their customers on. And so we found some really unique products that had to pivot because of COVID, because things stopped in person. And some of our biggest companies now were direct shifts due to COVID. And even though they had something we initially invested in, they found a way to make something work during that. And I think adaptability is a huge piece of this, because the company we invest in is not going to be the same company at the end of it. If they exit, when they get IPO, it's not going to be the same company at all. It's going to change drastically, and we have to be okay with that. And that's the way this works, is they're going to adapt quite a bit.
Right. Yeah, no, it's always impressive to see like how the companies go from that idea stage or pre-seed, seed round into the final version of the company and everything they've created along the way.
Yeah, and
Um,
I think COVID's been an interesting just case study in how these companies adapt to things, and really we've seen just so many weird things in the market here. And when COVID initially broke out in, let's say March, April 2020, basically a lot of the investors pulled out. So when we were there, our fund basically, we had already had our dry powder. We basically said we want to keep investing. So we invested in about 40 companies in 2 months because really there was no other investors out there, and we were just trying to basically every seed stage company was like, hey, we need money now. We need to raise. So we were getting all these companies, and that's really where we took off, was because we were one of the only investors still there that was investing. And obviously we've maintained that the entire way through. But I think we've seen the market really shift with COVID, and I think it's somewhat starting to normalize out. But I think we've really built this massive bubble of just companies raising a ton of money right now. These funds, somehow we have bigger funds than we've ever had right now during this weird time. I've seen 20, 30 companies raise $1 billion funds. So I think there's so much money out there right now. It's everyone's that stopped investing now has really doubled down lately.
and does that change how you think of, or your focus on investing? Either like have you, throughout the pandemic, have you shifted either the industries or the stages based on what else is going on in the VC market?
No, I wouldn't say we've changed much. I mean, obviously, COVID has affected a lot of things as far as like in-person event stuff is going to be difficult. Like especially if you're targeting in-person events in New York and LA, you're going to have a hard time. Um, so I think that's made things. You've kind of had to adapt to, like, what do we think could happen with this now? Do we think that there could be another shutdown? Do we think, where is this going to go? So we just really you have to be a little more careful of that. Then again, most of what we do is software anyway. So no enterprise software is really affected by this. So I'm sure there are some that have slowed down, because I know a lot of corporates have stopped spending, or at least they did last year. So that's really the only thing, is I think things slowed down quite a bit as far as customer acquisition on the enterprise side. But as a whole, I mean, I don't think our approach to the market hasn't really shifted. We're still looking for great companies anywhere we can find them in the world. And I think what they've built has had to shift, because I think a lot of people realize they have to adapt to COVID now, and it's not going away anytime soon. So we're just basically they're figuring things out along the way. And I think our thesis will change along the way, because we have to adapt as long as they do. So we'll stay with everybody else.
And so one of the other shifts I've seen along this topic here of the concept of money has been there's been, at least from my perspective, more companies going after alternative sources. More companies going the equity crowdfunding, or big surge in cryptocurrency and other ventures, other alternative methods there as well. How does that, the way you guys think about the market here?
Yeah, I mean, I love that now. It's great to see, like, all these big crowdfunding platforms have really taken off through COVID too. And I think those are great platforms. I mean, especially like I was saying, most companies shouldn't go the venture route. If you can raise good money and build a strong company through equity crowdfunding, that's great. I mean, you can raise a few million on there. You can go to the real, you can target your customers and really get a different group of people who aren't going to be looking for just those VC returns, but they're happy with a 10x, 5x return, whereas a VC is going to want 100x, 1000x, so I think that's a great middle ground for different companies as well. And I think that with those companies, I mean, we used Start Engine, WeFunder, Indiegogo, Kickstarter, all those guys. So there's plenty of other ones out there as well. But I think what they're doing in the market's been really great. I think as far as like the crypto side of things, that we saw a huge surge in ICOs for a while there. And I think that's slowed down as companies have raised so much money. I mean, a lot of those companies kind of just disappeared, it seems like. So not exactly sure what happened there. And I think it's an interesting way to do things. Not opposed to it. We had one company that did an ICO as well and raised a pretty substantial amount of capital on that. So there's a lot of different ways to raise capital right now. And the more there is, the better for the market, better for the startup. And really at the end of the day, you should be supporting the startups any way we can. So I'm not, just because they're not going to investors for money and they can find different ways to raise, that's a good thing for them. So I'm all for that. And we want to find as many ways to raise capital as we can, whether it's from regular people, through institutional investors, or through ICOs or NFTs now, or any way they can.
Right. Yeah, and then I know you mentioned like Expert Dojo, you have a significant portfolio in the US, but it's also a global portfolio. So yeah, like how do you find the companies? Do you have team members overseas, or how do you source deals from around the world?
Yeah, so when most of our deals come from our partners. So I work with a lot of investors around the world, and so I do the majority of our deals. We have a couple other people on our team as well that do a lot of the deals here as well. But we have a lot of deals from other partners there. So I partner with VC firms in India. We've got a lot of deals all over Europe. I do a lot of things in South America. I've got a lot of contacts in South America just because I've lived there for a little while, and know the market really well there. So we've done a lot of deals in Argentina and Chile. I think we have one in almost every South American country. And then we have partners, and we've done a few things in Africa as well. Most of the deals in Africa are located in Nigeria, Ghana, and South Africa. We have some sprinkled throughout as well, but most of them are in lately we've been doing a lot of deals in Nigeria, which is really interesting to see. And I mean, I never thought you never know where these amazing deals are going to come from, but we've seen some really great technology coming out of there. And then I'd say the majority of our international deals are probably in India. And we have some really good VC firms we work with there who refer us a lot of these early stage deals. So I think almost everything just comes from other investors, comes from people directly reaching out to us. You'd be amazed how much a direct outreach, just who actually has done their research and knows what we do, can really go far. I think a lot of the time people say cold emails don't work. Cold emails with a huge spam list, those don't work. When you're actually emailing people and say, hey, I actually know something about what you guys do, and I think this is why we're a fit, those tend to work a lot better. So I would say the majority of the cold emails I get are not good, but when we do get a good one, I'm always happy to speak to those companies. And I'm sure we've found a deal off of an email before, and I can't name one off the top of my head, but I'm sure we've got one. But the majority of our deals come from other firms, come from our partners, come from other accelerators, come from like venture partners, and then there's a lot of groups that basically just support startups, ecosystems, things like that. And we're always helping with those, doing things like jumping on conferences and speaking and doing things. So yeah, we have a lot of different sources to find companies, and we're looking for people all around the world.
Yeah, I love that. I want to make sure there's time if anybody has any questions, make sure to add them in the chat. And yeah, while we're doing that, yeah, would love to hear. So, you have all these partners. I really like what you said on the cold email side too. Anytime you can make them a little bit warmer and actually show you've done your homework, always goes a long way there.
It's always funny with I get
yeah.
like LinkedIn requests as well. It's kind of the same thing. It's just it's funny how many companies just will email us, will message us on LinkedIn saying, hey, I'm doing this round for $40 million. And it's like, it's obvious that they've done no research on my fund. I was like, okay, well, we're a pre-seed and a seed stage fund. Our check is 100K. We can do $1 million in the follow-on rounds, but that's a Series A typically. And like, if you're raising 30 to 40 million, we're not going to be a fit for you. So if you want to jump on a call with me, sure, just know this is what we do, and we're not going to be investing $40 million. And just because we can invest 100,000, that doesn't mean we want to get into a $40 million round because we have equity requirements, et cetera. And just when you do your homework on people, it goes a long way. I narrow things. And I have companies who will reach out to us, set up a call with me, and then find out that we're an accelerator. Even though they reached out to me directly, they wanted a call, and then I tell them what we do, and they're like, "Well, why are we on the call?" I was like, because you called me, you messaged me. So I just want to make sure that, I think I say this every time, but I still get hundreds of emails in this area. So just do your research. If you do your research, you'll find who are the right fits for you. And I think everyone will, and all the investors you reach out to will appreciate it more, and you'll probably have better success when you're reaching out too. So just know who you're talking to beforehand, know what they do in some capacity. You don't have to have an exact thesis of who they are in every little second, but you can look up on Crunchbase or anything else and just see, okay, this is what they do. This is the kind of companies they invest into, and this is the stage. That's really all you need to know, is just industry and stage. and then you're good to go. But yeah, just do your
Right.
research.
Yeah, we have a question coming in on when should you raise seed funding?
So, I mean, things have changed quite a bit in this. I think the way the VC ecosystem works is these stages have really started shifting up and downstream. I mean, just further and further downstream. So it used to be Series A was what seed is now, and now seed is kind of moved further along, and now what's really there is pre-seed. And so pre-seed to me is like 500K to 750K. Seed round is more like 1.5 million to 3 on the high end. So to when you start raising is the reality is whenever you need to. If you can build a company and you can start getting some sort of traction, you can get to the seed stage, but you just have to have a lot of metrics there. So a seed stage company at raising like a $1.5 million round, typically you're going to have 20 to 50K MRR. Depending on the industry, you can have companies that are pre-revenue that raise. It's not as common, not as likely. It depends on the industry. But if you've got an enterprise software product or like a company that does sales and it can actually build transactions, you need to have around that kind of revenue. So if you're not at that stage, raise pre-seeds, raise 700K, 50K, raise from angel investors, raise from accelerators. And just know where you're at with the company and know who fits in at that stage. A seed round, you should always be meeting investors, in my opinion. You're never in a bad stage to meet somebody. I mean, if you're talking to Series B funds, that's not a good deal in the beginning stages. Talk to pre-seed funds, talk to seed stage funds. So I speak to hundreds of companies throughout the year, and every time we say no to companies a lot more than we say yes. Just that's the reality of the situation. But I always tell companies, hey, this is what we're looking for. This is what we want to see. If you get close to that, let's talk again in a month. Let's talk again in 2 months. I think every VC fund wants to invest in as many companies as they can. They want to find companies that fit their thesis and their portfolio. You just have to be able to get to that stage. So usually what I'll do is I'll tell companies, hey, I want to see you do this. I want to see you execute this part of the company. You don't have to have this exact sales metric. There's not a specific number. I just want to see that you can get to a specific number. If we see the path to that, I think that's more important than actually getting to that number. That's not true, actually. Getting there is more impressive, but we want to see the clear path to a Series A, see that path to that growth round, because most companies fail between the seed and the Series A. They fail in that growth stage, and really that's where that valley is so big, is because you need to go from 20 to 50,000 MRR to 150,000 MRR to 200,000 MRR to get to that Series A, and that's just at the early stages of it too. So if you're raising a bigger round, the Series A is the most important part, because that's where most companies dies before that. Once you hit Series A, I mean, it's not great numbers still, but most companies are weeded out in the seed round. After the seed round, a lot of companies die right there. So we want to see that clear path to growth.
Oh, I think
did I answer the question there somewhere?
Yeah. No, that was great. Yeah, and then we have another one off of, or actually a couple here related to when or how important the startup's profitability is, and if there's a certain amount of time it should take to reach that break even after you invest.
Break even is not important, in my opinion. I mean, I think most investors would tell you break even is not important. I mean, look at Uber right now; they're still not making any money. So, I think to be a venture backable business, that's kind of funny. The funny thing with venture is you don't really have to be profitable to raise money and to grow, because they want you to be. Everything needs to be focused on growing. So if you're growing, doesn't matter if you're profitable or not. I mean, obviously you need to have revenue coming in so you can maintain that growth, but that doesn't really matter as much when you're actually raising the VC side of things. As far as the timing, like I said, speed's everything. If you talk to a company that's 5-6 years old, even if they haven't raised a seed round yet, most VC funds are going to be going, well, why have you not raised anything in 5 or 6 years? Time is your enemy. The older your company is, the harder it is to raise funding. So just keep that in mind as well. As far as how important is profitability in the beginning, it depends what your industry is. So if you have enterprise software, I think you need some profitability, because you need to show that somebody wants to buy your product. Somebody needs to. If you have like a social media platform, users, in my opinion, are the most important thing. Everyone will have different opinions on this, I think, but users are the most important thing, and then user retention is the most important thing. So it really just depends on the product itself and the industry, because not every industry is the same. A cybersecurity company is not the same as Facebook. You got to, well, now Facebook is everything, I guess, but you have to know your market and what's important, what metrics are important for your investors. So a social media consumer is customer acquisition costs, your customer retention, and enterprise is going to be really just getting those customers on. So sales is very important in enterprise software as well. So it just depends. You need to know what your industry is and what is important.
Yeah, no, you answered one of the other questions around the important key metrics for success there. So, is there anything on like when you're reviewing, or I'd say the startup overall, outside of the traction items, that is there one key metric or something you look for to say, this is a startup that's going to stand out from the rest?
I hate to say this, always the team is always super important. Who is it? Who's building it? What's their background? And do we think they can execute? Because at the end of the day, a great product will fail with a bad team. So you have to know that the team is fully committed. They're only focused on this one project. You need to have a singular focus. You can't be running 3 companies at one time and expect to raise VC financing, because it just won't happen. You need to have that focus and be building your company. And if the team is exceptional, you have some leeway in how early you can go. So if you'll raise earlier financing if your team is better. And if you're inexperienced, you don't give the investors that real sense of certainty that you're going to grow. I think it'll be harder for you too. And so there's a lot of ways you can show traction before even launching. So we had one of our more successful companies is a company called Unlu in India. They just raised a Series A with some larger funds. I can't say them on here, but I'm sure you can read it on Crunchbase. But they've raised from some really large VC funds. And when they came to us, they were pre-product, pre-revenue. But what they had all of these huge Bollywood stars and huge Indian athletics players. So people on the cricket teams, people on the Indian soccer team, and they had all of them already signed up on the platform before they even launched. So when they went live, they had these huge people already signed on, and their whole thing was on the consumer social media side of things. When they first started, it was similar to Cameo, so things like that. But they had all these people on there, and it was all targeting the Indian market. And when they launched, they were able to just go really fast out of the gate because they had such great people on. So even though they weren't launched, they needed money to get it live, to build out the product, to get everything done, get everything finalized. They had such great people attached to it, and they had done all these connections, and they'd done all this work already, that we were able to say, okay, this is how I get to that stage. And they were able to raise a seed round before they even launched. So there's a lot of things you can do to help validate the market with investors, especially.
Yeah, I really like that. And then, yeah, we had another question come through that's more on the cryptocurrency side. Not sure where it went. I just clicked answer live. There we go. Yeah, so it's about paper money. It's just the accepted mode for physical transactions, but the real value of money as an asset. Is cryptocurrency the way forward now?
That's a loaded question. I think you'd get a lot of different opinions from everybody else too. So I'll tell you what in the fintech side of things, I love what's happening with blockchain technology more than anything. I don't think that, the two are obviously not the same thing. I think a lot of people do equate the two together. I think what's happening with blockchain technology in the fintech space especially is very interesting. And I think a lot of companies are shifting everything that way, so that they can use any sort of currency. It doesn't have to be specifically cryptocurrencies. We've seen a lot of companies that are specialized in like international transactions, things like that. So as an international fund, we have companies that work with. One of our more successful is a company in Africa that all they do is currency exchanges, and they work with USD, all the currencies in Africa, all the currencies in India, the UK, whatever it may be, and just doing this. But they run it through a blockchain technology, and they actually do a lot of those transactions through cryptocurrencies as well. So I think that is what I've seen a lot of success with. I'm not going to claim to be a huge expert on cryptocurrency. I've been around it for a while. We know a lot of the big players in the space, but there's people who know it way better than I do and can tell you the actual future of it. But I think in the fintech space, blockchain technology is definitely going to be a huge thing that's going to be here to stay. And whoever can build the best rails in that is going to do very well as well.
Yeah, no, that I think that's great. And yeah, so with that, yeah, really liked all your responses. Appreciate all the answers here. And we're actually going to be going into a networking room shortly, where everybody can get to meet and interact with each other there. And I just want to bring back to the Pitch to Scale team to wrap up here and close us out.
Yeah, and I get on there just too. If anyone wants to just talk to me or anything afterwards, I'm happy to chat. Just John at Expert Dojo, JON at expertdojo.com. That's my email, and feel free to send me an email, and I'm happy to talk with you about your company, or if you just have any questions in general, I'm happy to jump on and give you some advice.